Hello everyone, in today's session we will continue principle of insurance. Now in our previous session we have discussed about two principle of insurance, that is principle of utmost good faith and principle of insurable interest. Now today we will discuss the remaining principles. Now first one is principle of indemnity. Now indemnity is nothing but to compensate the loss that you have suffered. Now all the insurance contract except for life insurance, all other insurance contracts are contracts of indemnity. Now the objective behind this principle is nothing but to put you in the same financial position before you have suffered any loss. Suppose if you had a car worth rupees 5 lakh and you have insured it, then due to some things that you have damaged your, or you have completely damaged your car, so insurance company, what they will do is that they will try to put you in the same financial position as before destroying or getting damaged that car, so they will compensate you with the damaged amount. Now in here one example is given. Suppose you are owner of house and your house is insured for 5 lakh. Unfortunately the house catches fire and half of the house is destroyed. Now in this case insurance company will pay only 2,50,000 because you have suffered loss worth rupees 2,50,000 as compensation. It is the amount of actual loss. Suppose the house was worth rupees 10 lakh but insured was for rupees 5 lakh. In this case, if the entire house is fully destroyed, then you will get only 5 lakh rupees because you have insured only up to 5 lakh, not for the whole 10 lakh. Okay. If half of the house is damaged, the insurance company will pay only 2,50,000. They will not give you 5 lakh. Okay, they will give you half of the amount of the insured money. The next is principle of mitigation of losses. In the event of mishappening, it is the duty of the insured that he must take all reasonable steps to minimize the loss in the same manner which he would have done if the property was not insured. Suppose you insured your house property and it suddenly one part of your house caught fire, then it, according to this principle, you should do everything in your capacity to put out the fire instead of standing in front of the house and waiting for whole house to get burned down. No, it is not like that. So it means according to this principle you should do as much as possible to minimize the loss, as if you should act in same manner or in same behavior that your property is not insured, because if the property is not insured, then you are going to suffer all the losses by yourself. And it doesn't mean that just because you have insurance you will allow your whole house to get burned down. Okay, this is meant by principle of mitigation of losses. The next principle is principle of causa proxima, or the nearest cause. Now for understanding this principle, let us see one example first. Sugar sent by ship was insured against sea hazard. Now a ship that was carrying sugar, they have insured against all the sea accidents. Okay, now rats they made hole by cutting the pipe of the toilet. Seawater entered through that hole and whole sugar was destroyed. So in this case the insurance company, they will pay you the insured money. Okay, but if in another scenario, if the rats would have damaged the sugar directly, the insurance company, they are not liable to pay for the risk, because the main objective of taking insurance was to protect the sugar from sea hazards. That is meant by principle of causa proxima, or the nearest cause. Means compensation will be paid to the insured if the causes responsible for losses were insured. Because in this example, the insurer, he insured against sea hazards, not against the rat problem. Okay, so if sugar was destroyed by rats, then the insurance company, they will not pay for the risk. Okay, then Next is principle of subrogation. Now, according to this principle, it states that after making compensation for the loss of the insurer, the insurer steps into the shoes of the insured. It means that the insurance company becomes entitled to exercise all rights and remedies. Now, for understanding this principle also, let us see one example. Mr. M, he insured his house for rupees 1,50,000. Now, there was partial damage, means whole the house was not damaged, only a part of the house was damaged by fire because of negligence of Mr. N. Now what Mr. M did is that he claimed for rupees 80,000 and it was admitted by the insurance company and they paid him 80,000. Then later M, what he did is that he filed a case against Mr. N that because of his negligence, Mr. M's house was damaged. So N, he gave him compensation of rupees 20,000 to Mr. M. Now since insurance company, they have already paid Mr. M the amount of loss, after that also he received 20,000 from N as compensation, then the insurance company, what they will do is that they will take that 20,000 from M, because even though after compensating his loss from insurance company, he is again taking compensation from third party, so that amount will be taken by the insurance company. And this is meant by principle of subrogation, means after settling the compensation, the insurer, they step into the shoes of the insured, means the insurance company, they become entitled to exercise all the rights and remedies which the insured had in respect of the property. Means the insurance company, they become the right holder, or they are supposed to get all the remedies which the insured person he can take from someone else. The next is principle of contribution. In certain cases, the same subject matter is insured by different insurers. The actual loss should be shared or contributed among all insurers. If the entire loss has been paid by one insurer, he is entitled to receive contribution from other insurers. Now in this example, one Mr. he insured his house to three companies, company A, company B and company C, and in that case his house got burned down and he claimed that amount of loss from A company. So since he have insurance from company B and C also, but he took all the amount of loss from company A, then what company A will do is that company A will take insurance compensation from company B and company C as well. Now in this example, let us see. For example, if a house has been insured for 3 lakh from A company, 2 lakh from B company and 1 lakh for C company. If the house is damaged and A company, now A company, they settle the claim by paying rupees 3 lakh. Then what A company will do is that he will take contribution from company B and company C as well, because company A is the only one providing compensation to the insurer. Okay, so insured. So he will divide his contribution and other two companies contribution in the ratio. So the ratio will be 3:2:1. So since he paid 3 part, he will take 2 part from company B and 1 part from company C. Okay, this will be C company. Okay, now there are different types. Mainly there are 2 types of insurance. One is life insurance and one is general insurance. Now general insurance, it is again divided into 3. First is fire insurance, marine insurance, and then miscellaneous insurance. Now let us see what is life insurance. Now life insurance, we all know that we will take insurance, then it is not exactly an insurance, but it is an assurance, because insurance, it relates with indemnity, means to compensate for the loss, but as we know, we cannot compensate loss of life. Okay, So usually it is assurance, but nowadays we call it life insurance. Now it is nothing but a contract between a person and the life insurance corporation. According to the contract of insurance, a specified sum of money is payable by the life insurance corporation on the death of the insured or after the expiry of the policy period, whichever is earlier. If before maturity of the period, if the insured dies, then the company, they will pay the amount. But if the insured doesn't die and his insurance matures, then he will be he will get the policy amount. Now the amount of the premium that every monthly or the small amount of money that we pay at a regular interval is known as premium. It is determined on the basis of the amount of policy, means after maturing or after the death, how much amount of money you receive, that is nothing but amount of policy. Now your premium amount depends on your amount of policy, then for how long you are taking that policy, and periodicity of the premium, means whether you want to pay your premium monthly, quarterly, half yearly or annually. Now there is an element of investment. In life insurance we have an element of investment because the amount of the policy is received in both cases, means either if the insured person dies also, or if he doesn't die and his policy gets matured, then he will receive his all the premiums plus there will be some amount of bonus as well. So there is an element of investment. If the policy is discontinued within 2 years, it is supposed to be lapsed policy and nothing is paid back to the insured. If the policy is surrendered after 3 years, means after continuing your policy for 3 years, if you want to surrender it before maturity date, then what insurance company they will do is that they will pay a part of the amount deposit. That means they will calculate all the premiums, how much you have deposited till now, and they will pay only a part of that deposited amount. Now the amount that you will receive after surrendering your policy is nothing but known as surrender value. Now when we talk about main elements of life insurance contract, these are nothing but easy essentials of valid contract. That means the party entering the contract must have contractual capacity, there should be lawful consideration and all. Then second is contract of utmost good faith, means both the parties should be faithful towards each other. Then there should be insurable interest, and next is it is not a contract of indemnity. Remember that insurance other than life insurance, they are contract of indemnity, but life insurance is not a contract of indemnity because you cannot indemnify life. That means you cannot compensate the loss of life. Okay, now I'm not going into detail about these elements of life insurance contract. You can just go through reading, as we have already discussed these points in previous topics as well. Okay, now when we talk about history of life insurance, in India it came around 300 years ago with Europeans. Europeans were the first one to bring life insurance in India. Now first insurance company was Oriental Life Insurance Company, which was started in 1880 for widows of European. In this respect, Indians availed the benefit with. In India, first insurance company was Bombay Mutual Life Insurance Company. Then in 1870 an Insurance Act was passed in India by British government, but after independence all insurance companies, they were taken by the government in 1956, means they were taken by the government. Okay, now in modern times LIC is the most famous insurance company in India. Now apart from other life policies, there are some particular policies available. There are money back policy, Jeevan Surbhi, Jeevan Sathi, then Jeevan Kishore, Jeevan Mitra, Bima Sandesh, Jeevan Akshay. You can go through this, but no need to study in detail about these things. Now when we talk about steps or process of obtaining life insurance policy, let us see what are the steps, means how you can take your life insurance. Now first is proposal form. Now first you will go to LIC office or any other insurance office. You will take form, and in that form you have to mention important details like your name, address, profession, status of health, means whether you have any sickness or not, then family history, and other details as well. Now all the materials that you are going to fill up in that form, they all should be true and factual, means because of the principle of utmost good faith. Okay, then medical examination. After you have submitted your form, the corporation or the company, they will send one doctor, means they will examine your whole body for medical background. Okay, then you have to provide your proof of age. Then you have to decide your premium, means the policy holders have to pay the insurance premium, which may be monthly, whether you want to pay monthly, quarterly, half yearly, or annually. Now when there will be a grace period of 30 days, suppose your premium becomes due on 1st of October, then there will be 30 days of grace period. Within that 13 days you will be given last chance to pay your premium, failing which you will have to pay certain fine as well. Then premium is payable in advance. If the premium is not paid, the policy is cancelled, but you can renew it with paying certain amount of money. Then risk. After the receipt of the first premium, the risk starts and continues. So far the premiums are paid on due dates. Then last is the acceptance of the proposal. If everything is satisfactory, the proposal is accepted, means they will check all your details in the form and all. If these are satisfactory, then your proposal will be accepted, and finally your documents and all those things will be sent to you with all the terms and conditions of the insurer. Then there are different types of life insurance policies. Let us see what are those. First is whole life policy. As you can see in the name, it is mentioned whole life, means this policy will continue your whole life. Okay, the amount of the premium is comparatively less because you don't know for how long you have to pay this type of policy. Okay, the period of the policy is indefinite. Its payment is made to the dependents of the insured only, means after the insured dies, then his dependents or his nominee will receive the policy amount. And then next is endowment policy. This policy is for a fixed amount and specified period. Now you will fix the amount as well as for how long you want to take that policy. If the policy holder survives for the period of the policy, he is paid the specified amount of the policy with bonus. It is, you can say it is kind of fixed deposit, but in this case, if the insured dies, then his nominee will receive the money. But if the insured survives through the period of policy, he will be getting some money with bonus after the policy gets matured. The next is joint life policy. As from the name itself, you can say like joint life means two or more persons jointly they are taking an insurance policy. These persons may be partners of firms, employees of an organization, member of family, etc. Now according to the term of the policy, the premium is paid jointly, means suppose two person they took the joint life policy, so both of them they will divide the premium amount and both of them they will pay the premium. But on the death of any one member of the group, means any one member dies, then the another policy holder or the joint life policy holder, the amount he will receive the policy amount or the amount as per agreement is paid. Then next is annuity life policy. Now in this policy, the amount of the policy is paid before the maturity of the policy after 1 year or the expiry of fixed period. Now annuity means annual. Okay, this amount of policy either they will pay you before the maturity or after 1 year of the expiry of fixed year. Suppose you have taken policy for 5 years. Then after 5 years plus they will add 1 more year, and after 6 year they will pay you the amount. The entire amount of the policy is paid on the death of the policy holder or after the expiry of the period of the policy, whichever is earlier. If the insured dies, then they will pay the amount, but if the insured survives, then after maturity they will give the policy amount. Then the last one is children endowment policy. In order to meet the expenses of the education and marriage of children, this policy is taken by parents. The premium is paid by the person entering into contract. No premium is paid if the person dies before the maturity. Now, this policy is not entered by the children but the parents of children, and if the parent dies, then he will before the maturity, then he will not get the premium. But if the child dies before maturity, then the policy is paid to the parents. Now this was all about life insurance. Now another type of insurance is general insurance. Now general insurance is very easy. All those insurance contracts other than life insurance are known as general insurance contract. Now these can be fire, marine, burglary insurance, cattle and crop insurance, etc. But mainly in this chapter we will be focusing on fire insurance, marine insurance and miscellaneous insurance. Now first let us see what is fire insurance. Fire no doubt is boon, but sometimes it may prove to be curse. Any sort of carelessness or negligence may cause fire and result in destruction of property and death of the people. The loss caused by fire may be compensated by fire insurance policy. Now fire insurance, it is an agreement between the insurance company and the owner of the property, wherein insurance company, after receiving some specified premium, assumes actual loss or amount of the fire policy. Means they will calculate actual loss that you have suffered due to fire or the amount of policy that you have taken against fire insurance. Now whichever is less, they will be paid you only that much account. Suppose you have fire insurance worth rupees 5 lakh, but the actual loss that you have suffered due to fire is 10 lakh. In that case, the insurance company, they will pay you only 5 lakh of amount. Okay. Now fire insurance is contract of indemnity, and it is based upon the principle of good faith. Now fire insurance, it is a personal contract. It is therefore necessary that the insurance company must satisfy itself about the character integrity. Means first, before they giving any fire insurance to a particular person, they have to check the person's character, his social status and all before giving any fire insurance. Plus they have to take certificate of respectability from insured as well. It is therefore necessary that all material information regarding the property must be disclosed. In case of fire, the actual loss or the insured value of the property, whichever is lesser, is received from the insurance company. Now let us talk about marine insurance. Now marine insurance is an agreement in which the insurance company assures to compensate for the loss, if there is any loss, caused by insured marine perils after the receipt of the payment. Marine perils means marine damages. Okay. Now marine policies can be taken for the ship itself, then or for the loaded goods or cargo, or for the freight or salaries of employees, and there are others as well. Now what are marine losses? There are many marine perils, so there are different types of marine losses. Now when we talk about losses, first is total loss. Total loss is again divided into two, but let us see what is total loss first. Now when we talk about total loss, it is very clear that the entire ship or goods is completely destroyed, or we suppose that it is destroyed. Now it is again classified into two. Actual total loss, that actually the loss took place. Okay, in that case Number one is if goods is completely destroyed due to physical reasons such as fire, flood, storm, etc. If the goods is deformed or disformed, then if the ship is lost, okay, then in these three cases, if the ship is sunk, if the entire goods is robbed, in that case we will consider it as a total loss, okay, total actual loss. Then next is constructive total loss. Constructive total loss means we have to consider as total loss. In this case, if the ship is abandoned, means we have abandoned the ship wholly because the cost of the repair of ship exceeds the value of ship itself. Means we have abandoned the ship thinking or considering that if we try to repair that ship, it will cost us more than the actual value of ship, okay. In that time we think it as a constructive total loss. Now when we talk about partial loss, in that case the ship is partly damaged and there is partial loss of goods. It is known as partial loss. Now it is divided into two. First is general average. Now these marine losses are borne by all the interested party. It is not necessary that one ship will carry only goods or cargo of only one company. Sometimes they used to carry lots of companies' cargo or goods in their ship. So in general average partial loss, what they do is that all the interested party, they take part or they divide the losses among themselves, okay. But in case of particular average, the loss is borne by only the owner of the subject matter alone. Now there is some difference between life, fire and marine insurance. You can go through and see the difference between these. Then the next type of insurance is miscellaneous insurance. Under these different types of insurance come, let's see. First type is motor vehicle insurance. Now motor vehicle is nothing but, under this insurance, vehicles on roads such as motor, trucks, car, vans, motorcycles, scooters, etc., they are insured. And if there is any accident or the victim suffers any loss, then the insurance company will compensate, okay. Now second type is burglary insurance. Means if you have suffered any loss due to theft or burglary, then the insurance company will compensate it. Then next is personal accident insurance. Now this insurance policy is taken to compensate for the loss caused by accident. If the insured person dies or meets any fatal accident, the insurance company makes the payment of the insured amount to the person himself if he survives, or to the nominee of the insured person if he dies. In case of partial disability, the amount is paid according to the terms and condition of the insurance policy. Now generally this personal accident insurance, it is taken with life insurance policy, okay. The next is fidelity insurance. Now this policy, it protects you against any embezzlement, dishonesty and fraud of employees. This type of insurance is taken mainly by the owner of the business, okay. If suppose if your business have suffered any loss due to dishonesty or embezzlement or fraud done by your employee, then insurance company, they will compensate you. The next is employees accident insurance. Now workers in a factory, they can face any accident while working, okay. So in case of partial loss of limbs or disability, the owner of the factories have to compensate for the loss to the employees as per provisions of the Factory Act. If the factory owner desires, he can get the risk insured with the insurance company, okay. So instead of just the factory owner, they have to compensate his employees if they suffer any loss due to accident in the factory. But the employer or the owner of the factory, what he can do is that he can simply take out compensation from his own pocket, or he can take this employee's accident insurance from any company. In case of insurance, the insurance company, they will provide compensation to the employee rather than the owner of the factory paying compensation to the employees. Then next is cattle insurance. Now this type of insurance is taken by the farmers, means to protect the farmers, where the insurer is compensated for the loss of cattle, that is bulls, cow, buffalo, due to its death. Then crop insurance. It is a contract which provides financial support to farmers in the event of crop failure due to drought or flood. If there is any loss suffered by the farmer due to drought or flood, then he can compensate his loss through this crop insurance. Now this type of insurance, they cover in the production of paddy, wheat, millets, oilseeds and pulses. Now insurance cover for all types of crops and all types of risks. It is not completely available in India, but in other countries it is available. The next is health insurance. Under this insurance policy, medical expenses of the illness and disability are covered by the insurance. This type of insurance can transfer the burden of the cost of illness or accident so that people do not have to face financial ruin because of poor health. Means if you have health insurance, then you can go to doctor or any hospital without any hesitation or without thinking about large amount of money that you have to pay as your bill or medical expenses. Now this kind of insurance, they provide different types of coverage, like it can cover the cost of sudden illness or disaster. It also covers the cost of hospitalization and fees paid to doctors. It provides income to the insured when he is not able to work due to physical or mental inability. Then it also covers nursing home expenses for senior citizen. If you have any senior citizen at your home and if you have kept any nurses, then you can take health insurance. Then next is, it helps in providing other benefits which are not covered by social security programs. Now what are the advantages or role of insurance in business? How insurance is important in business? Now insurance provides your business with protection. Insurance provides a safe future. In case of life insurance, the loss of an individual cannot be compensated, but the receipt of the insured amount from life insurance companies helps him in standing. So from business point of view, insurance, it can help you in compensating the loss that you have suffered, or it can provide you protection against any type of risk. Okay. The next is indemnity. The loss caused by fire and other mishappenings is compensated by insurance company. Insurance as such is the protection against losses which makes the business feel secured and free from anxiety. The next is element of investment. There is element of investment in life insurance. Whatever is paid is received with bonus on the death or the expiry of the policy, whichever is earlier. Means you can see it as an investment also in case of life insurance. Means whatever you pay, you will surely get it on the death or the maturity of the policy, as well as you will get some bonus also. Then it helps in compulsory savings. Means in order to continue the policy every month or every quarterly, or depending upon the time, you have to pay certain amount of money as premium. So it develops a habit of saving in you. Then industrial development. Now the amount that you pay as premium, the insurance company, what they do is that they invest those in industrial ventures, which helps in industrial development in the country. Now there are two small topics which you have to understand properly, that is double insurance and reinsurance. When we read these two words, these two sounds very similar, but there are some difference. Okay. Now double insurance is nothing but, in one of our previous examples we saw that a person, he took insurance from three different company A, company B and company C. So it is nothing but double insurance. Means the same risk is insured by two or more companies. It is just possible that a person can take more than one policy from two or more companies for the same risk, but he cannot be paid more than the actual loss as compensation. As we have discussed earlier, that even though he had taken insurance from two or three companies, but the actual loss that he's going to charge as compensation will get from only one company or from all the company. But those companies, what they will do is that they will divide the loss amount to compensate among themselves. Okay. Then reinsurance, it is sub insurance. Suppose if you go to an insurance company and you want to insure your house property for rupees 50 lakh rupees, and if by chance the company is not able to provide you with that huge amount of insurance, then what that company will do is that they will approach another insurance company, and both of them, they will provide you same insurance. Now that is known as reinsurance. Okay. In double insurance, one insured will be there, but two or more insurer will be there. But in reinsurance, one insured will be there and two or three reinsurer will be there. Okay. Now there are some difference between double insurance and reinsurance. Meaning, double insurance means insuring the same risk with two or more companies, but in reinsurance, it is a contract of sub-insurance between insurer and the reinsurer. Means the main company will be known as insurer, and the another company from whom that company has taken help is known as reinsurer. And then filing claim. Now in double insurance, you can claim with all the insurers, but restricted to actual loss. Means if you have suffered 80,000 of loss, then either this 80,000 you can take from one company, or all the three companies, they might give you 80,000 together. Okay. But in case of reinsurance, the insurer will claim compensation from original insurer, who will claim compensation from their reinsurers. Okay. Then contribution will be made by each insurer in proportion to the sum insured. Means in double insurance, the person, he have to pay his premium to all the three companies, and in case of reinsurance, reinsurer are not directly required to contribute for losses. Means reinsurer, the secondary company, they will not pay they will not compensate to the insured person directly. They will first contact with the main insurer, original insurer. So this was for business services chapter. Communication is not included in your syllabus, but if you want, you can read as for your general knowledge. Okay, so we have finished chapter 4, and from our next session we will start chapter 5. Thank you.